Hello and welcome. In this chapter, we will discuss the practical implementation roadmap for IFRS 9 or BFRS 9 in Bangladesh. In earlier chapters, we discussed classification and measurement, expected credit loss, PD, LGD, EAD, data requirements, governance, disclosure and reporting templates. And now the important question is, how can a bank actually implement IFRS 9 in practice? IFRS 9 implementation is not only an accounting exercise, it is a bank-wide project. It involves finance, credit risk, credit administration, IT, internal audit, regulatory reporting, senior management, and the board. A successful implementation requires proper planning, clear responsibility, reliable data, practical models, system readiness, training, and continuous monitoring. Without a proper roadmap, the implementation may become fragmented. One department may prepare the model, another department may maintain data, another may prepare financial statements, but the overall process may not be properly connected. That is why a structured roadmap is necessary. The roadmap helps the bank identify gaps, clean data, develop policy, build models, configure systems, conduct parallel runs, train staff, obtain approval, and move towards final implementation. In this chapter, we will learn the full roadmaps, step by step, using a practical case study of ADC Bank Limited. To make the implementation process easy to understand, let us assume that ABC Bank Limited is preparing to implement IFRS 9. ABC Bank is a medium-sized commercial bank in Bangladesh. It has 80 branches and a total loan portfolio of BDT 100 million. Its loan portfolio includes corporate loans, SME loans, retail loans, agriculture loans, credit cards, and staff loans. The bank uses a core banking system for loan records, but collateral data is maintained separately. Recovery data is partly maintained in Excel. Finance uses a separate system for general ledger reporting. During the initial review, ABC Bank identifies several issues. Historical default data is available for corporate loans, but incomplete for SME and retail loans. Collateral valuations are not updated regularly for many old loans. Recovery data is maintained manually and is not properly linked with loan accounts. Stage classification under IFRS 9 is not automated. ECL calculation is currently done manually using Excel. Financial statement disclosure templates are not yet developed. The finance team has basic knowledge, but branch, credit, and recovery teams need more practical training. The core banking system does not directly calculate ECL. Based on these findings, management decides to implement IFRS 9 in phases over 12 months. ABC Bank forms an implementation committee, performs a gap assessment, cleans data, develops ECL methodology, prepares models, performs parallel runs, trains staff, and prepares for final implementation. This case study will help us understand how a real bank may approach IFRS 9 implementation. A practical IFRS 9 implementation project may be divided into 10 phases. The first phase is project initiation and governance setup. The second phase is gap assessment. The third phase is data assessment and data cleansing. The fourth phase is policy and methodology development. The fifth phase is model development. The sixth phase is system development or system configuration. The seventh phase is parallel run and testing. The eighth phase is training and capacity building. The ninth phase is final implementation. The 10th phase is post-implementation review and continuous improvement. Each phase should have clear deliverables, responsible persons, review process, and approval authority. The phases are connected with each other. For example, model development cannot be completed without reliable data. Final implementation cannot be completed without parallel run and approval. Disclosure cannot be prepared unless ECL results are complete and reviewed. Therefore, the implementation should be treated as a structured project, not as an isolated finance department task. The first step is to establish a formal IFRS 9 implementation project. The bank should form an implementation committee or project steering committee. This committee should include representatives from finance, credit risk, credit administration, ET, operations, internal audit, regulatory reporting, treasury, legal and recovery, and senior management. The committee should define the project objective, scope of work, implementation timeline, project team, reporting structure, responsibility of each department, approval process, communication plan, and key deliverables. For ABC Bank, the implementation committee is chaired by the deputy managing director responsible for risk. The head of finance acts as project coordinator. The head of credit risk leads the ECL methodology workstream. The head of audit leads the system and data workstream. Internal audit participates as observer and provides feedback on controls and audit readiness. This structure ensures that IFRS 9 implementation receives proper attention from senior management. The key deliverables of this phase include the project charter, committee formation, responsibility matrix, project timeline, meeting schedule, progress reporting format, and issue escalation process. This phase is important because without strong governance at the beginning, later phases may suffer from delays, ownership disputes, and weak decision-making. After the project is initiated, the bank should perform a gap assessment. A gap assessment compares the bank's current practices with IFRS 9 requirements. The purpose is to identify what is already available and what needs improvement. The gap assessment should cover classification and measurement, business model assessment, SPPI test, impairment methodology, staging criteria, SICR assessment, definition of default, data availability, system capability, model readiness, collateral valuation process, management, reporting, disclosure, internal control, audit readiness, and regulatory reporting. For ABC Bank, the gap assessment identifies several important gaps. The bank's existing impairment process is based mainly on regulatory classification, but IFRS 9 requires an expected credit loss model. Therefore, ABC Bank needs to develop PD, LGD, and EAD models. Stage classification is not formally performed. Therefore, the bank needs to develop criteria for Stage 1, Stage 2, and Stage 3. SICR, or significant increase in credit risk, is not clearly defined. Therefore, the bank needs to define quantitative and qualitative indicators. Historical default data is only partially available. Therefore, the bank needs data cleaning and validation. Recovery data is manually maintained. Therefore, a recovery database must be developed. Collateral valuation is not updated regularly. Therefore, a valuation update process is required. Disclosure templates are not prepared. Therefore, finance must develop IFRS 9 reporting templates. This phase gives management a clear picture of the implementation work required. Data assessment is one of the most important phases of IFRS 9 implementation. ECL calculation depends heavily on data. If the data is incomplete or inaccurate, the ECL result will also be unreliable. The bank should identify all data required for ECL calculation. This includes borrower data, facility data, repayment history, days past due to default history, recovery history, collateral data, write-off data, restructuring and rescheduling data, internal rating history, and macroeconomic data. After identifying the required data, the bank should assess whether the data is complete, accurate, consistent, timely, and traceable. ABC Bank identifies several data issues. Some customers have duplicate customer IDs. Sector codes are inconsistent between the credit system and the core banking system. Days past due are not always updated daily. Collateral valuations are older than 3 years for some large exposures. Default dates are missing for old non-performing loans. Recovery amounts are maintained in Excel, but are not linked with loan account numbers. Write-off data in the finance system does not fully match recovery records. To solve these issues, ABC Bank cleans customer master data, prepares standard sector code mapping, introduces automated days past due extraction, requests updated valuation for large exposures, reconstructs default dates from classification history, creates a recovery database and reconciles write-off data. The output of this phase should be a validated dataset that can be used for model development and testing. After identifying gaps and cleaning data, the bank should develop a formal IFRS 9 policy and ECL methodology. The policy should cover classification and measurement, business model assessment, SPI assessment, impairment approach, 3-stage model, definition of default, significant increase in credit risk, staging criteria, PD, L, G, D, and E, 80, methodology, forward-looking information, scenario weighting, management overlay, write-off policy, disclosure policy, governance and approval process. The policy should be practical and suitable for the bank's portfolio, data availability, system capacity, and regulatory environment. A policy that is too complex may be difficult to implement. A policy that is too simple may fail to properly capture credit risk. Therefore, the bank should balance technical accuracy with practical usability. For ABC Bank, SICR is defined using both quantitative and qualitative indicators. For example, more than 30 days past due may indicate movement to Stage 2. A downgrade of internal rating by 2 notches may indicate Stage 2. Rescheduling due to financial difficulty may require Stage 2 or Stage 3, depending on the borrower's condition. Legal action, bankruptcy, or more than 90 days past due, may indicate Stage 3. ABC Bank also defines default as a situation where the borrower is more than 90 days past due, unlikely to pay in full, under legal recovery, classified as non-performing, bankrupt, or restructured due to severe financial difficulty. Clear policy and methodology help ensure consistent application across the bank. After policy and data preparation, the bank should develop ECL models. The main models are probability of default, loss given default, exposure at default, staging model, forward-looking model, and scenario weighting model. Let us start with probability of default, or PD. PD estimates the likelihood of every customer will default. ABC Bank may use internal credit ratings for corporate borrowers, historical default rates for SME borrowers, delinquency data for retail borrowers, and expert judgment where data is limited. For example, ABC Bank may estimate 12-month PD of 2% for corporate loans, 4% for SME loans, 3% for retail loans, 6% for credit cards, and 5% for agriculture loans. For Stage 2, lifetime PD will be higher because the bank considers default risk over the remaining life of the loan. Next is loss given default, or LGD. LGD estimates how much loss the bank may suffer if default occurs. LGD depends on collateral value, forced sale discount, recovery cost, legal enforceability, recovery time, and historical recovery experience. For example, a fully secured corporate loan may have LGD of 30%. A partially secured SME loan may have LGD of 45%. An unsecured credit card exposure may have LGD of 75%. A staff loan with salary-linked recovery may have LGD of 10%. Next is exposure at default, or EAD. EAD estimates the expected outstanding exposure at the time of default. For term loans, EAD may be close to the outstanding balance. For revolving facilities, EAD may be higher because the borrower may draw unused limits before default. For example, suppose a borrower has current outstanding of BDT 60 million and an undrawn limit of BDT 40 million. If the bank expects 50% of the undrawn limit to be used before default, additional expected drawing will be BDT 20 million. Therefore, EAD will be BDT 80 million. This example shows why EAD modeling is important for overdrafts, credit cards, and working capital facilities. All models should be documented, reviewed, approved, and validated before final use. IFRS 9 implementation usually requires system support. The system should be able to collect data from source systems, validate data, classify exposures into stages, calculate PD, LGD, EAD, and ECL, incorporate macroeconomic scenarios, apply management overlays, generate reports, maintain audit trail, support reconciliation, and restrict unauthorized changes. Some banks may use a dedicated IFRS 9 system. Some may modify existing systems. Some may use a controlled Excel-based model as an interim solution. In the case of ABC Bank, full system automation will take time. Therefore, during the first year, the bank decides to use a controlled Excel-based ECL model. However, the bank applies strong controls. Formula cells are locked and reviewed. File access is restricted. Input data is reconciled with the core banking system. A version control log is maintained. All manual adjustments require approval. A change log and supporting documents are maintained. These controls are important because Excel-based models are vulnerable to formula errors, unauthorized changes, and version confusion. Even if the bank uses Excel at the beginning, the process should be controlled, documented, and auditable. IFRS 9 implementation usually requires system support. The system should be able to collect data from source systems, validate data, classify exposures into stages, calculate PD, LGD, EAD, and ECL, incorporate macroeconomic scenarios, apply management overlays, generate reports, maintain audit trail, support reconciliation, and restrict unauthorized changes. Some banks may use a dedicated IFRS 9 system. Some may modify existing systems. Some may use a controlled Excel-based model as an interim solution. In the case of ABC Bank, full system automation will take time. Therefore, during the first year, the bank decides to use a controlled Excel-based ECL model. However, the bank applies strong controls. Formula cells are locked and reviewed. File access is restricted. Input data is reconciled with the core banking system. A version control log is maintained. All manual adjustments require approval. A change log and supporting documents are maintained. These controls are important because Excel-based models are vulnerable to formula errors, unauthorized changes, and version confusion. Even if the bank uses Excel at the beginning, the process should be controlled, documented, and auditable. Training is essential for successful IFRS 9 implementation. Different groups need different types of training. The board and senior management need training on the overall impact of IFRS 9, governance responsibilities, key judgments, regulatory expectations, and management reporting. The finance team needs training on accounting policy, classification and measurement, ECL, counting entries, disclosure requirements, reconciliation, and financial statement presentation. The risk and credit teams need training on staging criteria, SICR assessment, borrower risk rating, PD, LGD, EID, default definition, collateral assumptions, and forward-looking information. The IT team needs training on data extraction, system controls, audit trail, access control, data integration, and report generation. Internal audit needs training on auditing IFRS 9 controls, data, models, staging, management overlays, and audit readiness. Training should not be only theoretical. It should include practical examples, case studies, templates, and exercises. For example, participants may be given 5 borrower cases and asked to classify them into Stage 1, Stage 2, or Stage 3. They may also calculate simple ECL using PD, LGD, and EID. This type of practical training helps staff understand how IFRS 9 works in real banking situations. Let us look at a few practical training exercises. In the first exercise, participants are asked to classify 5 borrower cases. Case 1. The loan is current and borrower rating is unchanged. This is Stage 1. Case 2. The loan is 45 days past due. This is generally Stage 2. Case 3. The borrower rating is downgraded by 2 notches. This may indicate Stage 2. Case 4. The loan is 120 days past due. This is generally Stage 3. Case 5. The borrower is legally bankrupt. This is Stage 3. In the second exercise, participants calculate ECL. Assume EID is BDT 100 million. PD is 5% and LGD is 40%. ECL equals PD multiplied by LGD multiplied by EID. So, ECL equals 5% multiplied by 40% multiplied by BDT 100 million. The result is BDT 2 million. In the third exercise, participants compare Stage 1 and Stage 2 ECL. If EID is BDT 100 million, LGD is 35%, Stage 1 PD is 2%, and Stage 2 PD is 15%. ECL increases from BDT 0.70 million to BDT 5.25 million. The learning point is clear. Movement from Stage 1 to Stage 2 can significantly increase provision because Stage 2 uses lifetime ECL. Final implementation should take place only after all major activities have been completed. The policy should be approved. The methodology should be finalized. Data should be validated. Models should be developed and reviewed. System testing should be completed. Parallel runs should be completed. Major issues should be resolved. Staff should be trained. Management should review the financial impact. The board or relevant committee should approve implementation. Final implementation should include formal sign-off from relevant departments. ABC Bank uses a for implementation checklist. The checklist includes IFRS 9 policy approval, ECL methodology approval, data source mapping, data validation, PD model approval, LGD model approval, EID model approval, staging model approval, forward-looking assumptions, scenario weights, management overlay framework, system testing, parallel run, reconciliation, disclosures, training, internal audit review and board approval. Any pending critical items should be resolved before go live. Final implementation should not be rushed. A controlled and approved implementation is better than a quick but weak implementation. IFRS 9 implementation does not end after go live. The bank should continuously monitor and improve the framework. Post-implementation review should assess whether the model is producing reasonable results, actual defaults are consistent with estimated PD, recoveries are consistent with LGD assumptions, EAD estimates are reasonable, staging criteria are working, data quality is improving, system controls are effective, management overlays remain appropriate, disclosures are complete, and audit observations are resolved. For example, after 6 months, ABC Bank compares estimated PD with actual default rates. Corporate estimated PD was 2% and actual default was 2.2%. This appears reasonable. SME estimated PD was 4%, but actual default was 5.5%. This indicates that SME PD may be understated. Credit card estimated PD was 6%, but actual default was 7.5%. This also requires review. Agriculture estimated PD was 5%, but actual default was 6.8%. This requires additional sector review. Based on this review, ABC Bank decides to revise PD assumptions for SME, credit card, and agriculture portfolios. This shows why IFRS 9 requires continuous improvement. Models, assumptions, and controls should be updated when new evidence becomes available. IFRS 9 implementation requires change management because it changes how the bank thinks about credit risk, provisioning, reporting, and accountability. Common challenges include resistance from departments, lack of understanding, fear of higher provisions, data ownership disputes, system limitations, reliance on old regulatory provisioning mindset, and weak coordination between finance and risk. To manage these challenges, the bank should communicate the importance of IFRS 9 clearly. All relevant departments should be involved early. Now, training should be practical. Data ownership should be clearly defined. There should be a formal issue resolution process. Senior management support should be visible. Progress reporting should be regular. Decisions and assumptions should be documented. A communication plan helps stakeholders understand implementation progress and responsibilities. For example, ABC Bank holds project committee meetings every 2 weeks. Senior management receives monthly progress reports. The board or audit committee receives quarterly updates. OT, finance, and risk teams review data issue logs weekly. Training sessions are conducted as per the training plan. Audit readiness meetings are held monthly. Good communication reduces confusion and keeps the project on track. A responsibility matrix helps clarify who is responsible for each activity. For IFRS 9, the finance department may lead accounting policy, journal entries, disclosure, and regulatory reconciliation. The risk department may lead PD, LGD, EILD, staging, SICR and management overlay assumptions. The credit department may support borrower risk assessment, ratings, rescheduling assessment, and collateral information. The IT department may lead data extraction, system configuration, access control, and audit trail. Internal audit may review data controls, model controls, staging, and governance. Senior management may approve methodology, assumptions, and final results. The board or relevant committee may provide oversight and approve major policy decisions. Without a responsibility matrix, departments may assume that someone else is responsible. This creates delays and control weaknesses. A clear responsibility matrix improves accountability and reduces implementation risk. Every IFRS 9 implementation project has risks. The bank should identify these risks early and prepare mitigation actions. Poor data quality may result in incorrect ECL. The solution is data cleansing and validation. Delay in system development may delay implementation. The solution is project monitoring and vendor coordination. Weak model design may produce unreliable provisions. The solution is independent model review. Lack of staff knowledge may cause inconsistent application. The solution is training and workshops. Unsupported assumptions may lead to audit observations. The solution is proper documentation and approval. Poor coordination may delay decision-making. The solution is clear governance and issue escalation. Outdated collateral valuation may cause incorrect LGD. The solution is updated valuation policy. Excessive manual work may increase operational risk. The solution is automation or strong spreadsheet controls. Project risks should be reviewed regularly by the implementation committee. Risk management helps the bank avoid last-minute surprises. For banks and financial institutions in Bangladesh, IFRS 9 implementation should consider local realities. Common issues include limited historical default data, frequent loan rescheduling and restructuring, collateral valuation uncertainty, recovery delays, sector concentration, manual data processes, different reporting expectations under BFRS and Bangladesh bank regulations, limited model validation, expertise, staff training needs, and system integration challenges. Therefore, implementation should be practical and phased. A bank may start with a practical model and improve it gradually as data quality, system capability, and internal expertise improve. A typical month-wise implementation timeline may be 12 months. Month 1. Project team formation, project charter and governance setup. Month 2. Gap assessment and data inventory. Month 3. Data extraction and initial data quality review. Month 4. Data cleansing and data source mapping. Month 5. IFRS 9. Policy and methodology drafting. Month 6. PD, LGD, and staging model development. Month 7. Forward-looking model and scenario development. Month 8. System configuration or controlled Excel model preparation. Month 9. First parallel run and result analysis. Month 10. Second parallel run, model refinement, and disclosure testing. Month 11. Training, audit readiness review, and final adjustments. Month 12. Final implementation, board approval, and go-live. The actual timeline may vary depending on the size of the bank and system readiness. Senior management should present a simple IFRS 9 dashboard to the board. The dashboard should not be overly technical. It should highlight key information such as total gross exposure, total ECL allowance, coverage ratio, Stage 1 exposure, Stage 2 exposure, Stage 3 exposure, Stage 2 migration, top risk sector, management overlay, difference with regulatory provision, system readiness, internal audit review status, and target go-live date. For ABC Bank, the dashboard may show total gross exposure of BDT 100, 0 million, total ECL allowance of BDT 7, 311 million, coverage ratio of 7.31%, Stage 2 exposure of BDT 11, 840 million, Stage 3 exposure of BDT 510 million, and management overlay of BDT 625 million. This type of dashboard helps the board understand the IFRS 9 impact without going into excessive technical detail. Let us summarize the key points of this chapter. IFRS 9 implementation requires a structured roadmap and strong project management. The implementation process should include project initiation, gap assessment, data cleansing, policy development, model development, system configuration, parallel run, training, final implementation, and post-implementation review. Training is essential for the board, senior management, finance, risk, credit, IT, internal audit, and reporting teams. Change management is important because IFRS 9 affects the responsibilities and behavior of many departments. A responsibility matrix helps ensure accountability. Parallel run helps management understand the financial impact before final implementation. Post-implementation review ensures that models, data, assumptions, and controls remain reliable over time. For banks and financial institutions in Bangladesh, implementation should be practical, phased, well-documented, and aligned with both BFRS 9 principles and Bangladesh Bank expectations. A successful implementation roadmap will improve credit risk management, strengthen financial reporting, support regulatory compliance, and build confidence among stakeholders. Thank you for watching.